Simply Financial with Christopher Calandra, Certified Financial Planner, is an innovative, comprehensive, informative, and cutting-edge podcast that discusses financial topics ranging from personal finance, economics, politics, and personal growth. Simply Financial will cover intriguing and thought-provoking questions so that the listener can simply increase their financial IQ.
Welcome to the Simply Financial podcast. I'm your host, Christopher Calandra. This is Season 3, Episode number 2. And I wanted to talk today, along with my special guest, about what the heck happened in 2018. So much changed in the markets and in the economy and in sentiment in 2018. We're going to discuss what the heck happened. 2018 was the worst year the market has seen since the great financial crisis. The fourth quarter was particularly bad. And the early going in 2019 has seen a continuation of the volatility. So we're going to discuss today what the heck happened. I have with me a close friend and business associate, Dean Nicholson. He is an economist with almost 40 years of experience in the financial services industry. He was a financial advisor, and he and I worked together for many years. He has since retired. He's given up his securities license. In fact, I was fortunate enough to do a deal with Dean and acquire his book of business some time ago. But he and I consult with one another and collaborate quite a bit. He's a great resource for me and the rest of the team here at Elliott Wealth Management Services. So with all of the goings-on in the market and in the economy, especially in the fourth quarter of 2018, I asked him to join me so that we could just talk a little bit about what happened in 2018, what investors should be focused on, discuss a little bit of the outlook for 2019. Of course, these are his opinions, my opinions. We do not have a crystal ball. But before I bring Dean on, and I just wanted to kind of set the stage, because for nearly 10 years now, the stock market has been practically unstoppable. Both the 122-year-old Dow Jones Industrial Average and the S&P 500 have quadrupled from their March 2009 lows. Those were the lows that were reached as we came out of the financial crisis. Many investors who've held throughout these couple of interruptions since then have been very well rewarded. For a variety of reasons, October 2018 started the return of heavy short-term market turbulence and volatility. This has been one of the roughest episodes the market has seen since the great financial crisis. And of course, this has made things very challenging for investors. Since hitting their all-time highs in late 2018, the Dow Jones has been in correction territory. And a correction is defined as a decline of 10% or more. The S&P 500 has also hit correction territory with a drop of over 10% from its all-time high. And the technology-heavy NASDAQ composite has had an even tougher go of it, with declines that are somewhere in the 16 to 18% range since hitting its peak. So clearly, investors are worried. It's a disruptive, stressful, disconcerting time for everyone involved in the market. So I wanted to have Dean on to discuss some timely information that might be helpful. But again, setting the stage, it's important to recognize that market corrections, as I just referenced, is a decline of 10% or more from a recent high point. Market corrections are far more common than most people think. Since the beginning of 1950, the S&P 500 has undergone 37 corrections of at least 10%. And there's been numerous other occasions where the markets have had drops that are in the high single-digit range. And this data comes from an analytics firm called Yardeni research. But if you think about that, that's an average of one correction in less than every 2 years. But the stock market does not follow in a straight path to the averages. So you could have 2 corrections in a year and none for 3 years, and then 3 in a 6-month period. It really is all over the map, but it does demonstrate, this historical information does demonstrate how common declines are. Unfortunately, when you're in the midst of a decline like we've experienced over these last bunch of weeks, especially with the media really being all over this news, many people believe that it's something that is very different and out of the ordinary. And unfortunately, between Dean being in the business for almost 40 years and an economist for almost 40 years, and my 26 years as a financial advisor, we've seen this lots of times before. And the last point I will make before I finally bring Dean on is, despite being common, market corrections come often without warning, and over the long run, it's largely impossible to figure out when they're going to start and when they end, and to put your finger on exactly what is causing it. We're going to talk about several things that we think are affecting the market, and also talk about some things that are cause for optimism. And the final thing I'll say, really the final thing I'll say, is that short-term traders tend to be the most impacted during corrections. When we work with clients, and this was the same when Dean still held his licenses and was actively working with clients, is we have a long-term perspective. We're trying to be successful over the long term. But short-term investors are going to be the ones that are most negatively impacted by corrections and market dips. And what we do for clients, investing over the long term, being diversified, and using tried and true investment strategies, is a good recipe for success. Not a guarantee, but a good recipe for success. Short-term traders do not have the same recipe. So with the stage set, Dean, thanks so much for joining me today. I'm so appreciative.
So Dean, in your opinion, what the heck happened in 2018?
Oh, no, I appreciate the opportunity. I just want to kind of confirm the reason that I sold my business to Chris, is that I believe that he has the correct perspective for an investment advisor. You can't make decisions on the short-term movement in the market. And as an economist, I have a tough time because I'm not emotional at all, objective and somewhat mathematical, which is exactly opposite of the emotional stock market. But that being said, the long-term performance of the market is very closely related to the increase in the population of the United States. So to kind of keep it simple, the overall performance of an investor's portfolio over a period of time, if, this is a big if, and this is one of the reasons I sold my business to Chris, if you're well diversified, your portfolio is at least going to perform equal to the increase in population. And it's a very simple explanation, and it isn't normally given, and I haven't heard it anywhere else. But basically, if your population is increasing, you think about it, you have more people buying more food, you have more people buying clothes, you have more people buying houses, furnishing their houses, and you have more people buying the services needed to survive in a modern economy. So if you have all the companies that are producing these articles for an increasing population, and you have a reasonably efficient economy with liquidity and stability of its currency, and the U.S. is one of the few that has those characteristics, most of the problems created, and I'll restate this because it's extremely important, short-term investors get hammered in these conditions because they're trying to buy more winners than losers. They're not trying to use a Nobel Prize-winning theory of investing called modern portfolio theory. Now, I'm an economist, And until someone else wins a Nobel Prize in economics with their investment theory, I'm going to go with the winners. And they're Markowitz and Sharpe from the University of Chicago. And what they did is they analyzed the performance of the stock market in like 9 different categories. I'm not going to bore you with the difference, but basically they produce a thing called the Callen chart. You can go and Google it, Callen or AN. I'm sorry, I'm not a good speller. And check that out. And what it does, it shows over a period of time the best performing sector in the market is versus the worst performing sector, and it's color coded. And what's interesting about that is that the top producing sector is like a random walk. In other words, you look at it and say, geez, there's no characteristic that could describe this. But if you really take a look at it, you'll notice that the color that's at the top usually ends up near the bottom and then back up to the top in a period of about 5 years.
Sure. So I mean, in the simplest sense, Dean, is what you love today, you may turn out to hate tomorrow, and the investment that you don't like today will have its moment in the sun a little later on, and you'll love it then, right?
Exactly correct. When I was in the business, I tried to explain, look, if you take a look at your statement and you have more of your holdings up versus down, I consider that to be great. If all your holdings are up at the same time, we're in trouble because they're going to correct and you're going to be hammered. So what you try to do is try to buy what's out of favor at a given time and hold it so when you do need some income or sell something and pick that part of the sector because you own that because you bought it already, then you can sell it and then you won't go into your principal.
All right.
Concept of,
So much happened in 2018. When we look at the major stock market indices, they had their worst performance year in 2018 than they have had since 2008. And a lot happened, especially in the latter part of the year. So what are your thoughts on the downturn and let's start with some of the causes of what created anxiety and selling pressure in the market? What do you think some of the key drivers have been?
Well, the more emotion that enters the market, the more volatile it's going to be. Adding to that, algorithmic trading is now used by certain types of funds, increase that volatility. But it's emotion. People are reacting short term. Many times they'll act incorrectly with the data because they don't understand economics. So what's actually a positive movement, they'll interpret that to be a negative movement and then sell. And then once it gets to be in a selling situation, the algorithms kick in and more sales are made. The uncertainty, a lot of investors really, obviously would be more comfortable getting an 8 or 9% CD than they're in the market. So they don't like any uncertainty. Well, what causes uncertainty? Well, you have the China trade and tariff question.
Yes.
Uncertainty. You have interest rate movements, which I think are great, but any type of change disturbs people. That's a concern. And you have the political situation where some people are handling their investments as if you're supporting one candidate versus another, one party versus another. I know of people here where I, in a retirement community, so lived in they have when Obama was elected. Then I had people that sold it, not my clients, I wouldn't let them do this, but other people would sell all their investments because Trump got elected. So one of the problems, people are confusing political reality with economic reality, and it's hurting them tremendously.
No, that's very good. So let's take them, one at a time. So we have a president and an administration that is committed to updating and changing our trade deals around the world. And the president has done a number of things. Number one, I think, is pulling out of the TPP, the Trans-Pacific Trade Partnership. He's renegotiated NAFTA. He's been negotiating with our trading partners in the EU. And most recently, he is trying to establish